Good afternoon, everybody, and welcome to Gary's Traders Group. This is your host, Gary Humeski. It is Monday, January the 19th, Martin Luther King's birthday today. The markets were closed. Like always, let's get through the disclaimer real quick. These webinars are for educational purposes only. I'm not giving any trading advice. Trading does involve risk. So these webinars are designed to educate you and further enhance your knowledge in the trading process. Okay. Okay. Markets were closed today. So I've got a whole bunch of things I want to go over with everybody. First, let's take a look at how the rest of the world did. It's one of the things I do every morning, folks. Before I scalp the market with the E-mini, I need to know what Europe and Asia did. And this just happens to be a site I go to, Bloomberg, and look at the world markets. There's plenty of other sites you can go to do this, but this just happens to be a creature of habit for me, kind of like when you go to a classroom. You pick a seat, and when you come back, you tend to stay in that same seat. People don't move. We're all creatures of habit. So you can see the Europe and Middle East here is it's done okay. The Swiss market's done okay. What I look for is I look at the FTSE, and then I also look at the DAX, which is the German exchange. Those are really the two main ones that I look for in Europe to see how they did. I don't look at the FTSE indexes or any of these. They're just not that heavily traded, but the DAX and the FTSE is. So then I go to Asia Pacific and see how the Hang Seng and the Nikkei did. Hang Seng tanked, but there were reasons for that. I think I saw that on Market Watch. Richest 1%, something else about fears. 12 money saving travel tips, NFL, Microsoft, things to do, blah, blah, blah. Fed officials are on track for 2015 rate hike. There was some news that had triggered, oh, here it is, something to do with the Swiss may act again. You may have been warned. So something to do in there kind of send jitters over to the Hong Kong market, and that's why you see a collapse in it where the rest of the markets have done pretty good. Okay, so let's go to a little tighter picture and see what's happening in the economic calendar, what you have to look forward to this week. We have the housing starts coming out tomorrow, or I'm sorry, Wednesday. I thought there was a retail report coming out, but I guess it's not. So 3 red stars, housing starts on Wednesday. Jobless claims on Thursday in the morning, and existing home sales. This would be an interesting statistic to see because it's really indicative of how America is viewing these low rates that have been sustained for quite a while. I remember my parents bought a home back in 1968, and they paid 4%. And throughout the 70s and 80s, I thought that I'd never see those kind of rates again, and lo and behold, here they are. So those are 3 things to look for. Be aware of them in case you are entering or exiting a position. Okay, let's take a look at the macro picture. By the way, once again, if anybody wants my TOS setups, I give them out for free. Just email me, and I'll be glad to share a link. One of the things TOS has now we're able to do, which is really great, they're just such an innovative company, is up here on the right where it says setup. If you go down the menu, it says share workspace. And so I can easily share my workspace. It just sends you a link, and if you have an account at TOS, it automatically goes there, and you're able to duplicate what I have. So now, if anybody also, I'm going off a little bit on a tangent, so you know I do that sometimes. As you know, I've added these 2 very, very important items, IV rank and implied volatility. It is a really helpful tool for you to learn how to use. It was on a Tasty Trade Tom Sosnoff episode that says Game Changer. You can Google it if you want and find it. Game Changer through Tasty Trades, and you'll see the Think script on there. If you want, though, I can email it to you. and it's very simple to add. But these are important to know. I'm sure everybody has heard the term sell the vol. Sell the vol. It means selling the volatility. When you have high volatility, like you see on ADM with Archer Daniels, I happen to be looking at it, you can sell, so again, you have to be directionally correct in whatever side you're selling on, be it the call side or the put side, the long or the short side. It looks like Archer Daniels is really having a nice roll. You can also remember to bring up Best Choice and take a look at what it does seasonally. And it looks like it's got a nice track record of 13 years, 12 winners, 1 loser, surrounding around earnings. And you can look at where is it statistically sitting at from the lowest it's ever been to the highest it's ever been. So it's kind of below the mean, 50%, which is kind of good. You want to see that. You don't want to see it way sitting at the top of the range, because then you can't really use this tool as something to be able to help verify the potential direction of a trade. I am, by the way, today going to, what is the name of the script? Lost it on my chart. IV rank. Oh, Bob and anybody else, I have noticed this script disappears after it's been loaded for some reason. I don't know why. This is the first time, though, I've been able to actually save it. When I pull up my workspace of Traders Group, every time I did that, this suddenly disappeared. Now, for some reason, it's staying. Why? I don't know. But if you have that problem and you have the script, just go back to the email or however you got it. Hopefully you saved that script someplace in a folder or in your email folders. Just copy and paste it again. That's all I can suggest. I don't know why, but it disappeared on me, Bob, about 2-3 times as well. So anyways, what I was going to be saying about Best Choice, we've all here on this webinar spent money. I've spent my blood, sweat, and tears for 6 years with this company, which I think is worth just as much as $5,000 that somebody spent to buy the software. But there are things that are very beneficial with the software. Like any other tool, you just need to know how to maximize the use of it. Seasonality is one thing. Linear regression is another. We know what these deviations are. But I'm going to show 2 things, or actually 3 things today, on how to create lists and how to use it to find 3 different types of trades that I think are very valuable, that are very high probability as well. There are some people that have emailed me that, really want to be able to get their trading level to another level, to the point where they can actually use the income from trading to replace their income from their current positions. A lot of you just want to supplement, or a lot of you are in a position where you're already retired. But either way, the key is to create as much consistency as possible. I know there's some people that are going to be listening to this recording, and it's important to know there isn't really one perfect system, or one system that happens to be more consistent than other. I think a lot of that has to do with your personality, your style of trading, and how you understand how the markets work, and using those tools to the best of your advantage. That will create more consistency than any specific system that you go into. I hope that makes sense to people. So I am going to show 3 trading scenarios that can be set up with Best Choice that I think would be valuable. They can produce returns of 100+% per year. I don't know about you guys, but I was in the financial service insurance business for 24 years, and I used to counsel people on how to be able, where to put their money and how to get a good return. Some people had a little bit more risk adversity than others, but primarily very safe, secure insurance products, annuities and those kind of things. But one of the things the insurance company came up with to rival their cousin in the securities market, called a variable annuity, which that money happens to be tied to the market. and actually portfolios of stocks that you can choose from. But you also have the same risk as any venture into the market. There's risk of loss, whereas fixed annuities, you don't have that risk. It's a fixed set return over a period of time. You're basically exchanging your money for a contract, and the insurance company is going to pay you a percentage rate over that particular period. The point being is they came up with hybrids, and one of them is called an indexed annuity. Also, there's an indexed universal life, which is a very interesting product. Used properly, can create a tax-free income. I actually ran a scenario for my son who works at Google, and he's making really good money. And he had already maxed out what he could contribute to his 401k and Google matching, and he still was looking for different places to perhaps put his money. He experimented. He opened up a mutual fund and, and went into some global stuff and, just to kind of play. He didn't put a lot. I think he put $1,000 or something into it. But I ran a scenario for him that if he took what the company was matching based on his payroll deduction that was going into the 401k, which he could afford, into a indexed universal life based on the low interest rate of a 7% return over time. Now, this money is also tied to the market. The difference being with the indexed universal life or indexed annuity is that you get all the upside of the market, but none of the downside. Whatever you earn, you keep. They can never take away. Catch is they cap how much you can earn. But that is pretty significant. It is 15%. 15% tax deferred in a 28% tax bracket. That's a hefty return. And if you do it for someone that's 27 years old like my son, and you compound that over time at age 65, the numbers were staggering. He'd have over $850,000 worth of life insurance death benefit that he would have for the rest of his life. We wouldn't have to put a cent into. But just as important, he created $100,000 a year of tax-free income for the rest of his mortality life according to life expectancy tables, which have all increased in 92 and 93 in the life insurance industry. They actually run them out to 120 years old because there's so many people that are living 105, 110, 120, and that started to skew the statistics, so they had to set their actuarial tables, and rates have actually gone down. So, point being is these strategies that I'm going to talk about, they're more conservative. They're buying time, but they can produce a good return over time. And it's a little bit like watching paint sometimes. It's not going to give you the exciting bang of trading Netflix that comes out with earnings tomorrow after market and trading a cheap out-of-the-money call expecting it to go up, and it gaps up and busts through your strike price, and boy, you just made a fortune. Those are exciting times, but unfortunately, we all here have experienced the downside of that. And as you start to grow in your trading experience, you try to find more consistency. So I want everybody to be able to maximize the tool of best choice. Let's go through, also, by the way, you see this? This is called an AD ratio, advanced decline. In other words, it's a 4-to-1, which is what happened on that particular day. What do I got, a 1 year? On this particular day, which, if anybody understands candlestick patterns, anybody tell me what that candlestick is or represents in candlesticks? It's one of the basic candlestick patterns to learn. Nobody? Oh, come on, guys. Somebody knows what that is. Well, let's have Best Choice tell us then. It's a bullish engulfing candle. Sorry, my neighbor is outside and the dogs are protecting the house. I apologize about that. So anyways, bullish engulfing, and I'm so sorry, folks. And then with best choice, it's showing with their deviation of linear regression oversold. We don't have a MAC turned up, but remember, MAC's going to react a little bit slower. But again, you have the hash mark. Remember what that means. It's a great tool to use. It statistically means for the swing trading program. That's what that was designed for. Where this is your stop. These are your stops, and where's the probability based on the 1 cent move of a breakout to the upside is 90% when this hash mark is purple. So going back to toss, and this will show you who is leading the pack that day and when things could potentially turn around. I mean, that will fluctuate during the course of a day. But it definitely also tells you who's in charge, the bulls or the bear. That's a little added value to it. All right, 4:21 my time. I spent a lot of time revamping the recap Excel sheet that I send out. It's a whole new format. I hope you guys appreciate it. I've done it to where it's all on one page now. It doesn't run off. So if anybody wants to print it, it will print without cutting off symbols or trades, in the middle of them. I've also now started to put 5 different strategies per trade. You're welcome, Jose. And there's a bunch of other people that wanted me to do that too. And actually one guy called me and say, hey, can you do this? Because I print it and 3-hole punch it and put it in a book. And I thought, I didn't even think about that. So it's all nice and neat now on one page, and you'll be able to easily print it if you want. But again, I'm putting now 5 different strategies on that. And I'm still doing directional trades, on be it earnings events or seasonal trades. I'm also going to start putting some more on calendar spreads, which is something I've ignored. And this is for people like Bob and Steve and Melissa. I mean, all of you people like to trade these the calendar spreads, which are great, and that's one of the things I'm going to show you how to be able to create with Best Choice, to be able to come up with more trades on a weekly basis. That's something that I'm definitely going to do. So, it's the format is going to look like that. So it's all going to be on one page. I'm always, if there's earnings events that are happening, it happens to be earnings season, that's always going to be first. From the longs to the shorts, and then seasonal, longs and shorts, then calendar spreads. And I'm also going to be putting in my win-loss ratio. I have to look back after I do it. For example, I did it for last week's. And so you'll see this as a change as well. The ones that are winners will be in green, be it even on the same symbol, but maybe a different strategy worked better. And this will help you guys to be able to say, even though I bought a put perhaps on Tuesday of, after the webinar, and I thought, Intel was going to be short, but it didn't move. Excuse me. Hold on a second. My apologies. It didn't move as much as I want. Well, if you did a bear call, bear put, or sold a strangle, using these strike prices, you would have made money. So you'll see the strategies in green that made money and the strategies that lost money. And then I've started to put the win-loss ratio at the bottom. Okay, so that's another thing that I've been added to do. It's for you guys to help you guys in your learning. So with that, let's go over some of the earnings trades that I found that are upcoming that are notable to look at. The big boy is Netflix. It's coming out after market tomorrow, NFLX. It's the best time of year to trade them. You could see that it really pulls up every year. I believe this is set on tab 3. Let's do it to best trading whole zone, minimum number of days of 14. And you highlight that, and it's 9 out of 9 years. And it's moved very significantly in the last 4 years. Here's one of my concerns. You know, I'm getting back into physical fitness heavily. I have a degree in kinesiology, actually, from the University of Michigan. And it's something that I love, and I understand what endorphins and dopamines do for your mind and your body. It helps with trading. It helps with everything. And I have a personal trainer that I hire to basically push me beyond what I would normally do. But just like with that, you know, for the last 2.5 weeks, Monday, Wednesday, Friday, he's been increasing weight on each of the exercise, pushing me more and more and more. Well, that's analogous to an earnings. Every time Netflix is besting earnings by analysts, that benchmark goes higher and higher and higher. And they literally have to do over 52 cents EPS this earnings in order to be able to beat analyst expectations. So just like with my training coach increasing my weight, yeah, it's working so far. I'm being able to handle it, but there will come a point where I simply can't. So I hope that kind of makes sense to you folks of what could potentially happen with Netflix. I think I saw that on Seeking Alpha. Something interesting you can do, if you should do that, because a lot of times they will say, you know, the preview, what to expect. As you see, that's what I looked at as earnings preview for their Q4. I'm sorry, the street is 45. So it's good to see what they say. You can go through the overview and look at things and see where they're standing. And at the end, there's always a summary, if you just want to encapsulate it without going through a lot of the technical. They've beaten estimates over the last 3 quarters by 3 cents to 13 cents. Consensus having been 49 cents 3 months ago for this quarter. The company would probably have to report EPS of 52 cents on revenue of $1.49 billion to view positively by market participants. So do please keep that in mind when you're potentially looking to make a trade on this. I hope the analogy of increasing weight for every workout I do to a point where I can't do it, is that potentially going to happen with Netflix? Something just simply to be aware of. But from a seasonal standpoint, very, very strong looking trade. Since the market did move today, very easy to look at. What kind of open interest is this? We're obviously looking at a February expiration. They're not cheap, are they? Pretty expensive. But if you took the statistic of where do you expect this to go, and you take 25% and add that to a stock price of $337, my gosh, that puts you out way, way out. It puts you out, I think, at over 400 and some. But again, look at your deltas. A rule of thumb I learned from one of the best choice users out in California, runs a $500 million hedge fund, is He never looks at anything with a delta less than 20. And I adopted that. It made sense. So the 385 for $6 would give you a delta of 22. Now, I don't know what's going to happen tomorrow. I mean, Netflix, I will tell you, had one of the reasons I have analyst upgrades here is on my Gary's 11, especially if there's any earnings coming out, I want to see if what analysts are saying, upgrade or downgrade, because that makes a big difference from an emotional perception of the consumer. And last week, Netflix did get an upgrade. I think it was Friday or Wednesday, and that's one of the reasons their stock popped. If you took 337 and multiplied it by 1.25, it puts you at 421. And that's stretching it, folks, way out here. But look at it. It happens to be where there's a lot of open interest, 689 open interest contracts. The only strike level that's higher, there's only 2 of them. One is much closer to the money, at 350. And then the other one is at 400. So with these deltas being so low, I would never entertain that. So let's go to the charts. This is on 6 months. Is this 6 months' time? I don't think it was 6 months. I think I put it in closer. Or 6 months. We do have a breakout from 4 different triggers. The MOBO DPO, the MOBO on the price chart, the person's pivot study, and the HMA. Those are all very, very positive signs. See how the market reacts tomorrow. Now, right now, the futures are down at 38, and you guys should be looking at this pre-market. You should have these symbols loaded because this will be indicative of what potentially the market's going to do on market open. Doesn't mean that events during the day can't change that, but generally speaking, that's going to be the flow and direction of the market is based on what the overnight is doing. So see where it's at. You know it's a big pop. If you are bullish, you could do a bull call spread, and spread trading is very easy. You're simply buying one closer to the money and selling one further out. That's all. And the sale of the one you do further out helps offset the cost of the one that's closer to the money. And it's a very good way to trade. It's a defined risk trade, so you know exactly how much you'll make before you go in, as well as you know how much you're going to lose, potentially. And it's basically the same thing like buying a call or buying a put. It's the dollars that you put up. But one of the things I wanted to look at that I, for some reason, didn't do is the Fibonacci to see where potentially could it pop to. There's the high to the low, and now you have your Fibonacci settings. So 50% retracement is right at 403. And 61.8, which is huge, is the 423. Well, that happens to be real close to where that 25% of current stock price is, right? 423, 421. Okay, let's go to the third tool to help you is the MMM, which is the market makers movement. That's what these things are here, called market maker movement. These are the light ones, not the probability of touching, but the one in light. So if you go to February, go across, they're talking about a $46 potential up or down move. So let's put this in memory and take 337 plus 46. Well, that only puts you to 383. So, and these are the market makers, what they believe based on Greeks and open interest and options and on. I don't know how they figure it out. But that's another tool to say, am I on track or am I way out? So maybe 380 would be a conservative play. 380 happens to be right here for $6.95, which is really only about 2% premium. You could go a little further out, pay a little bit less. But I would probably stick to the 380s. Sorry, I'm filling this in as we go on. Now let's do a bull call. The thing about bull calls, you can go closer to the money. That is by a vertical. It costs you $2.40. I want this under $2.50 if I'm doing a vertical with a $5 spread. Now, would I be willing to pay $2.40? Yeah, it's not bad for day before earnings. Now, if I'm expecting the stock to go up, now you can always click confirm and send, see what your risk reward is. Remember, you need to know risk reward before you enter a trade. And when you're doing bull call spreads with a $5 spread difference, like you're seeing here, 335, 340, there's a $5 spread. And it's $2.40. That means I can make $2.60 or $2,600 based on 10 contracts. If I bought 10 contracts at $2.40, that would represent $2,400. So that's the max I could lose, and the max I could make is more than what I could lose. So your risk reward is greater than 100%, which is good for debit spread. Now, you could say, well, I expect this thing to pop, and so therefore I'm going to go further out. And I haven't explored this, but you could say, well, let's, instead of the 335s, 340s, let's go to the 370s. Just to see what they cost. Oh boy, could you make more money on that one? Sure. 10 contracts, you spend $1,280, but you could make $3,720. Now, that's predicated on the stock going in our direction. But your risk reward is greater. You'd lose less and make more. So you could play around and see where these numbers break out. And it's easy to do. You could just go and click this instead of single, click vertical. And now you don't have to do it. You can see where the pricing is at. And just look for spreads where you'll make bigger money. See, here's 55 cents. Here's 60 cents, right? The 365, 370s. Here is 65 cents. You see what I'm saying? $1.78 for the 355, 360. Good risk reward. So that's another way you can look, and just mathematically you can see where's the biggest spread and bang for the buck. Now these will all change tomorrow, but this is one technique you can do this on. Excuse me for a second. doing my webinar. I'll call you back. Okay, can everybody hear me? Hello, hello? Can you hear me now? I just want to make sure. Okay, good. Thank you. Okay, so you can also, and I'm going to do this on one because I've got so many more that I've listed. You guys can go through it. This is for education so you guys understand how to do this. Change this back to single. Another thing you can do is sell premium. Now remember I said selling vol? Look at that. The rank is 75. What does that mean? That's on a scale from 0 to 100. Even though it says implied volatility is 57.24%, you know, you'd think, well, how is that compared to historically? Well, that's what this IV rank is doing. It's looking back over 252 days, which is 252 trading days, an entire year, and it's saying, where is that volatility today? The scale from 0 to 100, based on a whole year's worth of volatility. And it's saying it's the 75 percentile. That's actually how this is written. It's written as a percentile, even though it posts as a rank. And as I said before, I prefer that. So knowing that, you can take advantage of it and say, I'm going to sell that volatility. And you can see where there's open interest. And all you're doing is you're reversing from buying. Instead of, see, if I put my cursor here, it says buy. If I put cursor here, it says sell. It doesn't matter which one you put it on. You just right-click it, and instead of buy, you put it on sell. And it's going to create a credit. Now, with a credit spread, you need to have the stock move in your direction because you have your risk-reward. Your risk is greater than your reward. But it's a very high probability trade because inevitably what happens is all of these prices are overpriced right now because of the binary event that comes out tomorrow, the unknown event. Binary meaning two. It can go up or it can go down. So there is inevitably going to be huge volatility crush that comes after this, and all of this volatility will be sucked out. I don't think I have, or no, I got IV right here. So that's again doing at the money, and you can click confirm and you'll see what your risk reward is. Maximum loss is 2,700, but your profit is 2,300. What you're doing is taking advantage of that high volatility and saying, I expect it to go in this direction. These are overpriced, and what I am, for example, I put this on the ask. Now I'll do the same thing on the bid, and it won't matter. If you sell a vertical, it'll still come out the same, $2.30. And that's the credit that you receive. You pocket that money. That's yours. And what you want is these two strike prices, one that you sold and one that you bought. Again, this is normally, if you just bought a straight put at the 335, it would cost you $20.70. Or it's a lot of money, right? 2070 times 100 is huge money. It's over $2,000. So to offset that cost, you've sold that 330 right there. You've sold that, and you pocketed $18.20. You sold it to somebody. They're expecting it to go down, so they bought it. And then you take that $18.10 and you go out and you say, okay, I got $18.10 in my pocket to buy that 2070. And so really what you're ending up, you're actually paying less than what you bought it for, so they're going to credit you that money and you pocket it. Again, it has to go in your direction. You expect these two to expire worthless if you held it to expiration. The other method of trading this is after the earnings, i.e. Wednesday morning, If Netflix does go in your direction in the favor of going up, which is what we expect it to do, then these premiums will all drop significantly. Because remember, you have a tool now with these two. And even if you don't have these scripts, I shared this last time, you can go to today's option statistics. And it's going to tell you the same thing. There's the IV percentile. They've rounded it to 76. This says 75.52. It's just got 2 decimal points out. So 75.52, if you round it up, is 76%. And then if you say, well, okay, what's the implied volatility? Implied volatility is 57.24. Rounded down, that would be 57. Well, this is saying 58.20. So you have that ability to take a look at that and say, wow, that's pretty high. I think I'm going to sell that volatility. So that's the third strategy. I wouldn't recommend selling a condor on this, only because condors work better if there isn't a huge pop. Because if there's a huge pop, there's one leg that could absolutely crush anything that you're making on the other leg. Now a strangle is another method of trading this and trading the vol. That's selling a strangle. What is a strangle? Well, you can change this and you could learn yourself and say, okay, what's Gary talking about? A straddle is like riding a horse. You put one foot on this side, one foot on this side, and it's equal. So you're buying in the same month at the same strike level. You're buying a put and you're buying a call. Whereas a strangle is you're buying one strike out of the money and you're buying one strike below at the money. Instead of the same strike, it's strangling it, putting an arm here and an arm here and strangling that position. But selling a strangle is the opposite. You're not buying. Okay? So you want to be on the put side because you're selling. I see a lot of people loading up here. So let's sell a strangle. Wow. Huge credit. Okay, but see, the reason you're getting that huge credit is because you're selling 10 325 calls. Well, 325 is 3 strikes in the money. So you really can't do based in toss because they're just doing 1 increments. Again, you're selling both sides. So you could go further out of the money on both. Just left click this and 1, 2, 3, 1, 2, 3. And so I'm going to hold the control key and sell that. Still a huge premium, right? Again, based on the expected move on what the MMM say, the market maker moves of $46, that puts us at 383. You guys remember that? I think it was 383. So I would go out giving it the benefit of the doubt slightly above what I expected, and I'd sell the 385s. And so how many strikes out is that? 1, 2, 3, 4, 5, 6, 7, 8, 9. So 1, 2, 3, 4, 5, 6, 7, 8, 9. It's a huge credit. It's a huge credit. Now, infinite potential loss. And even if let's just say I did this again. and I'm going to change this to one contract. Oops. See, pocket $1,280. It's pretty significant for one contract, right? But you have infinite potential loss. So what you're hoping is that it'll never get to your strike levels. It'll never get to 3 to 5 because you sold that 385. You sold that call. Now you covered yourself by selling that 295 put to somebody as well, so you can use the proceeds of that to offset. In other words, you have to manage the trade, and that's another thing that somebody asked me to start doing is towards the end of each session, opening the mic up for anybody that has trades on that they would like to have me potentially explain in what I would do if I was in that scenario and you're in a position, it's not necessarily moving your way. How do you manage each leg? You know, which direction would you do? Would you scale out a little bit? Would you scale in? Could you buy another month out? You know, there's lots of different techniques you can use in managing money. But again, understand the selling a condor is more of a defined risk. For example, if I just sold an iron condor on this, and again, I'm just showing as an example, I wouldn't do these strike levels, but you get a $5.25 credit. Difference being is, and again, I'm assuming it's going up on the call side. Well, yeah, it says caution, potential interest rate dividend or assignment risk because it exists. My profit is 52.50, but that's because I went so far out. Let's go on the opposite side. And where's the 295? So it's another strategy you could do. It's more of a defined risk. But I've seen these kind of strategies, even though this looks like, well, this is a no-brainer, Gary. You know, again, this is using 10 contracts. Remember, condors can kill you in commissions, right? I mean, because you're buying 4 different strike levels. So it's 4 contracts going in, 4 contracts going out. Now, if you have $1.50 per turn, which is what I have at Thinkorswim, it's still, you just add it up, okay? So each one in and out is $3. So 3 times 4 is $12 in, $12 out. So it's $24 based on one. But, I'm sorry, $12. Times 10 is $120. So make sure that you've got your commissions built in and it exceeds what you're doing. So this is a strategy that you could use going out of the money and selling that vol by selling a iron condor. Okay. Just going to go over real quick some other trades. I've already listed them in the spreadsheet. FFIV is another trade coming up. It has a high historical probability. HON, Honeywell, another historical good probability, 8 out of 9 years. SWKS, Skyworks Solutions, as another 8 out of 9, and each one of these I've looked up for open interest and volume, and there's a lot trading right now in SWKS, a lot. So probability of touching for February's, if you bought the 75s, is 90%. It's 51% at the 80s for $1.70. And $1.70 is only about 2.5% premium. There's great open interest. If you take a look at just the expected move of 10%, puts you to 81. So historical probability puts you there as well. And again, I've written in bull call and bull puts and condors and strangles on all of these. You can look at them. Again, this is all based on today's end-of-day pricing, or actually yesterday's, because today the market wasn't open. So there's those. What else do I have seasonally? Well, before it runs away too long, does anybody have any questions they want to ask me right now while there's still time? Be it in your position, and I'm going to take a look at it, or any stocks that you're looking at that you want me to take a look at here seasonally, or with the thinkorswim technical analysis. Go ahead and speak now. Otherwise, I'm going to just start going through some more seasonal trades that are open. What's happening with Apple? Somebody asked me. I don't know. Let's take a look at Apple. I haven't looked at them lately. From a seasonal perspective, 70% probability to short based on 14 days. 70% probability to short based on best profit per trade, same thing. Just higher rating when you do the 13th to the 27th. Apple has earnings coming out at the end of the month, the 27th after market. Pretty beat up from a high of 119.75 to sitting at the bottom. Depending on what happens tomorrow, if it takes a nice pop, it's sitting right at the bottom of linear regression. Yeah, I mean, take a look at that. You got earnings coming out. Analysts don't like it. Oh no, you got 21 say strong buy. Let's see, Credit Suisse on the 13th, which was just last week, right? Last Wednesday, put a target of 130. So let's go to a 3-month. Actually, I like a 6-month better. See, on something like this, I would probably do an extension rather than a retracement. And with a extension, I'm going to look at the last, this is the run up and the run down. So I'm going to go from this level down here to up here to down here. And here's where it's potentially can extend out to. Because if you look at, from a seasonal perspective, really what happens after earnings, there's a 90% probability to go up. I wouldn't make this a trade through earnings. I would wait till after earnings and then play it long. Okay, I did promise I was going to go through a couple of strategies here, which I'm going to do. For long-term trades, I think people need to start looking at doing that. Your search wizard, add your basic 5, bring your volume up to over 500,000. Take your stock price. I like to do it over $30. 31.40. Now, really what you're looking for is stocks that are growing. So you want to put on an earnings growth rate. So look for earnings growth rate. You could do 1 year or 2 year. I'd usually do a 1 year. And this is where you don't want to bring it up too much. And I know for calendar spreads, I was bringing in, the price consistency up to 80% because I wanted narrow bands. I was bringing growth rate up to 80% because I wanted the explosive divergence between earnings growth and price, because that would indicate the price would eventually catch up to earnings. But it just didn't show as many trades, and logic would suddenly dictate, I have to change one of my search criteria. So which one am I going to use to bring down? And it dawned on me. I was looking at Disney, just happened to be because my ex-wife works for him. And did you know that Disney has had a 22% growth rate? And it's had almost a 200% appreciation over the last 2 years? And it's only had 22% growth rate. So I would bring this up to maybe 30%. And these are 188 of real good long-term candidates. So this would be for long-term trades. You can do the same thing. Now, when I say these, what are you looking to do? Let's save this user list. As a long-term. Go to your user lists, your last one. This company is Ancestry. I don't know what's happened to them. Did they get bought out? Yeah, something happened to them. So that's not a candidate. What I'm looking for is this. But I'm looking actually over a 1 year period of time. This is actually showing tremendous growth. So what I'm looking to do is play the role on linear regression, buy a 6-month out term and sell the spot month. It's exactly like a calendar, except a calendar you're actually buying the next year, which is called a leap. The concept is the same. This is that you're just doing growth, though you're not putting price consistency, because you'll find a lot more trades. And it's easy to go through these. Like Archer Daniels would not be something I'd be interested in. Even though if you go to a year or 2 years, there's more consistency here. This was great, but this has been very volatile. So it's something I'd probably stay away for. This is what I'm looking for. And then I'm looking, let's say I was sitting right here, and I bought 6 months out. So this is April the 2nd. So let's go to October. So I'd be buying Octobers. I'd be buying Octobers and selling that and play that down. You want to sell the call because you're expecting the stock to go. It's got good growth. It's growing up. It's earning money. So I'd sell that, and then I would eventually, I'm offsetting the cost of buying all of this time by selling this front month. Inevitably, this strategy, then you can roll and do it again the next month. Roll and do it again the next month. And you just keep rolling it. And then eventually your October is free and clear, and it's actually appreciating. It's a way to generate income every month. By selling that front month, you create a credit. And it's a very high probable, low risk trade because you're buying a lot of time. This is the same parameters you can use for calendars as you do for long term, except you're going to be adding price consistency instead of just growth. And again, you can tighten up how many stocks you're going to be seeing with this by bringing the price up if you want. Again, I just set a criteria of $30. And the things that you're simply adding is, again, you want stocks that are growing well, so you want to throw in growth rate, but just do 30%. And what this will do, Bob and Teresa and everybody else, this would give us a lot more trades to look at on a weekly basis. Now throw in price consistency. That's the second criteria that you don't do at the long term. And price consistency is further down. See, price growth rate consistency, throw that on. And again, use 30% for this. There's 3131. 153 stocks. Save this list. For calendar spreads. Again, you're not using the wizard to find you probability trades because that's default, unless you really know how to manipulate the actual parameters, which for something like this, you'd have to do shortest possible days of trading days of what 6 months is, you know, so the shortest possible trading days, you'd have to put like 126. So you could see where, in other words, well, not 126, excuse me, you'd still want to have the shortest possible trades for how many trading days. There's 22 trading days in a month, make it 21. So you'd bring this to 21. You'd bring this, and I would do it in a multiple of 7. So again, that would be 126, which is a multiple of 7. So you could use that and then run it through and see what trades it comes out with. I prefer not to do that. I simply go to the list. Where's my 19 calendar spreads? Did I have 19 or 18? Does anybody know? Well, either way, I mean, you could see I don't know what date I put there. There's Archer Daniels again. Now, that's something interesting. Stock has gone straight up. Earnings, there's tremendous divergence between price and earnings. You can see that divergence. I mean, from an economic standpoint, this continues. In other words, if this continues in that fashion of earnings, it means it's an undervalued stock. The price will have to go up over longer term, and that's why a leap would be good for this. You know, you'd want to go to an option chain, be it with Best Choice or with Thinkorswim. Well, this only goes out to September, unfortunately. So I really couldn't buy a leap on this. I could potentially look at what is the annualized premium for the front month is 35. And let's go out to June and see what June's is. Well, June's is 18. The spread between that 18 and that 35 is what you want to pocket. So, but you know, we have a problem, Houston. No open interest. Next. So I would just go through all of these BBY. Anybody trade BBY as a calendar? There's a nice looking one. Real consistent. So that would be the calendar spreads. And the last is the opposite of what I did for the long term. The long term, I did the basic 5. And again, bringing the volume up to 500,000. Stock price I prefer $30 or higher. But instead of adding growth rate for 1 year at 30%, I'm going to add price consistency 1 year at 30%. Actually, I could bring this way up. That's too many stocks. There you go. Bring price consistency up to 90%. It's 146 stocks. Save that. And call this, this is what I call it. It's called a swing trade. Because that's all you're looking to do is play the role between linear regression. Why am I not showing this? 119 swing trade is not showing for some reason. Oh, I'm not saving it. That's why. Duh. Okay, you guys get my gist. Those are the three ones I wanted to show you. Long-term trades, sell the front month, buy 6 months at a time within the year. Same concept with calendar spreads, but you're buying the next year if it's available, like January of 17. You have to look at what the cost is of that, what the cost is of the front month, and again, you're just buying that time to bring and reduce the premium down of buying that further out leap. But it's a way to generate consistent money with very low risk. The last is the swing trade that I just talked about. Same basic 5, volume up to over 500,000. I prefer price over 30. Put on price consistency, growth rate, and with that, as you saw, I brought it up to 90% to get 144 stocks to look at. And what you'll do is you'll play the role. These will be very tight bands on that last list, and you just play when it's oversold and roll it up. Play when it's overbought, roll it down. But you're using a long-term 2-year chart to do it. That's the key. Okay, somebody asked me, and I'll finish up with this because I'm running over, to look at a stock called Save. One concern I have, Leon, with this is that there's very little history, especially right now. 3 years does not make a repeating pattern. It's a good look, and I have a couple of stocks like that in my watch list as well. And you know, you have some good potential growth. This would be more based on a fundamental and technical than it was be a seasonal. I'll say that right off the bat. So if I went to a technical aspect on this, vol is low, low rank. Let's take a look at what a year looks like. Kind of in the middle. So is the Mobo DPO. It's not, in other words, overbought or oversold yet. We could see even on a 6-month it's in the middle. I mean, over the last week or two, the progression is down. But if you're looking to play it long, I still think it has some legs to go down based on that last chart. A lot of open interest in February. A lot of excitement. What is there in March? A lot of excitement in March as well. The 80 in March. Two-year I don't like. 2 years telling me, like I say, it's still got legs to go down. Everything is pointing down. Even though really nice growth rate on this, the 49 is above that 89, looks real good, but it's not ready to go long yet. So I'd give it some time because these premiums, both on the 75 as well as the 80, are going to come down. But definitely based on these linear regressions, it has a probability of going up. And even at the middle linear regression at 78, and with the upper being 91. Sweet spot of 80 would be very, very probable since the last high was 85. And I'd wait for it to come down a little bit more before I went in. Okay, that wraps it up for today, folks. No audio? Hello, can you guys hear me? Hello, hello. Can you hear me? Okay, good, good. All right, good. All right, guys. Appreciate your time. Good luck trading, and I wish everybody the best. And until next week, this is Gary's Traders Group signing off.